Welcome to Talk Tickers, where we dig into the earnings calls that are moving the market. And boy, do we have one today with Employers, Inc. That's ticker EIG. Their Q3 was a real head-scratcher, a classic case of a headline beat that's actually hiding a much messier story. So let's get right into it and figure out what's really going on here.
All right, so if you just glance at the top line, you'd think everything was great. Employers put up total revenues of $239.3 million. That's a jump of almost 7% year over year, a really solid beat compared to what analysts were expecting. So you're thinking, okay, good quarter, right?
Well, hold on, because this is where the story just completely falls apart. The market, the consensus was looking for a profit, something like 60 cents a share. But what did the company actually deliver? A non-GAAP loss of $1.10. That's not just a miss. That is a massive miss.
So what happens when you go from an expected profit to a big loss?
Yeah, you guessed it. The market's reaction was swift and it was brutal. The stock just got hammered, falling more than 8% right after the news hit.
Okay, so let's get to the heart of it. This is the big question we need to answer. How does a company beat on revenue, but then post this huge earnings miss that craters the stock? The whole story, everything you need to know about this quarter, is wrapped up in that contradiction. And just look at this, it really shows you how huge this gap was. You've got the analyst consensus way over here in the green, expecting a profit, and then bam, look at the actual adjusted number, way down in the red. The gulf between what everyone thought was going to happen and what actually happened, well, it couldn't be bigger.
So what caused this giant hole in their earnings? It all comes down to one thing, a single, pretty painful move. Management took a huge $38.2 million charge. Basically, they had to go back and beef up their savings account for claims from previous years. In other words, they realized they hadn't put enough cash away for old policies, and they decided to fix that problem, all in one go.
So you gotta ask, why now? What forced them to make this big, sudden correction? Well, it all boils down to a problem that's been bubbling under the surface for a while now, and it's very specific. It's all about California, and a particular kind of claim they call cumulative trauma.
And these cumulative trauma claims, or CT claims, are a real headache. The CEO, Kathy Antelo, she laid it out pretty clearly on the call. See, these aren't your typical slip and fall accidents. No, these are injuries that build up over a long time. And here's the kicker. They often get filed after someone has already left the company, sometimes even years later. For an insurance company, that is an absolute nightmare. It creates this thing called long-tail risk, which basically means a policy you thought was profitable years ago can suddenly come back and bite you. It makes it incredibly tough to figure out how to price your current policies.
So management's message was really clear. They're trying to say, look, this is a California problem, and only a California problem. They're positioning this huge charge as them being proactive, getting ahead of the issue, taking their medicine all at once. They want investors to believe that the rest of the business outside of this specific issue is perfectly fine.
Okay, so management is saying they've got it handled, but the market's not so sure. That 8% drop in the stock, that's the market screaming, we're not convinced. Investors are clearly skeptical. They're worried that this isn't a one-and-done fix, and that there could be more bad news coming down the pike from California.
All right, the market is officially spooked. So what's management's game plan? How do they fight back and win back trust? Well, on the call, they laid out a pretty clear two-part strategy to tackle this head-on. So on one hand, you've got the operational fixes. They're getting tougher in California, right? Tightening up their pricing and who they'll insure. At the same time, they're looking to cut costs across the board. Then on the other hand, you have the financial levers, and this is where they're getting really aggressive. They're going out and borrowing $125 million to pump up their share buyback program to a massive $250 million. And they're doing all this while keeping the dividend steady. That's a big statement.
So if you boil it all down, their playbook looks like this. Step 1, protect the bottom line. They're saying profitability is more important than just growing for the sake of growing. Step 2, get aggressive with buybacks. They see their stock is cheap, and they're going to use the company's money to buy it, which supports the price. And step 3, look to the future. They're not just playing defense, they're planning to launch a new product in a couple of years to find new ways to grow.
Okay, so that's their plan. But what does it all mean for the next quarter and beyond? This is where we give you our take. Here's what we think happens next.
All right, here's our call. First, for Q4 earnings, we're actually predicting another miss. Why? Because all these fixes they're making in California, well, it takes time for that to actually show up in the numbers. The loss ratio is probably going to stay high for a bit.
Because of that, we think the stock is going to be volatile, probably with more pressure to the downside. The market's in a prove-it-to-me phase right now, so we're slapping a market perform rating on it. The California problem is a huge risk, but that big buyback program should act as a safety net.
And I really want to double-click on this buyback because it's the real wild card here. Management said on the call that the debt they're taking on to fund this is at a fixed rate of just 3.7%. I mean, in this environment, that is practically free money. So they have the green light and they have the cash to buy back a ton of their own stock. That could soak up a lot of the selling and really put a floor under the price. Honestly, this is the #1 thing you need to watch.
So, to wrap it all up, Employers Inc. just ripped off a very painful Band-Aid to deal with its big California headache. Now they've got a plan to fight back. It's probably going to be a bumpy ride for the stock for a while, but that huge, cheaply funded buyback is the key thing that could keep it from falling further. This is not financial advice.